Hey, everybody. Welcome to a brand new episode of In the Money with Amber Kanwar. If you're enjoying the podcast and you want those pro picks right to your inbox, make sure you go to our website, inthemoneypod.com, smash that subscribe button, and you will get these insights straight to your inbox. This episode is a really great one. We know that U.S. stocks have been underperforming global stocks. Is this the start of a big new change? We spoke to James Cook of Matco Financial. He's got an interesting perspective. He's definitely taking exposure to global stocks, but he's not yet ready to give up on U.S. stocks either. He'll tell us where he's finding the best opportunities and the best starter ways to get exposure to global equities. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. You're going to hear about some interesting stock ideas on this podcast. And to help you research and potentially act on those ideas, consider BMO Investor Line. Their platform provides the resources you need to analyze potential investments with the valuable tools and research you need when exploring the market. Plus, you'll find the BMO Investment Learning Center with educational courses and videos empowering you to make informed decisions. Learn how you can earn up to $3,500 cash back when you open a new account at bmo.com/online investing. Okay, James Cook, thank you so much for joining me today.
Oh, thank you for having me.
So we're going to talk a little bit about global stocks. And it's so interesting because almost to the day of Donald Trump's inauguration as U.S. president, U.S. stocks have started to underperform after years of outperformance and really being the dominant force in the markets.
Yeah, it's certainly been a bit of a tide shift. I think if we step back a little ways, this is also our 5-year anniversary of kind of the COVID lows, right? And so there's been a number of changes over these last 5 years, and fast forward to 2024 with Donald Trump coming in as president. There was a lot of excitement about his economic policy and the prospect for the U.S. economy, and you saw, a pretty impressive Trump bump in U.S. stocks through November, December, January, and kind of mid-February. I think when you start walking into a region like the U.S. and you're pricing at 23 times on a forward multiple, there's a lot of expectations built into the market.
Yeah, and that's
now you're starting to see it.
I just want to highlight that's an expensive number, 23 times forward earnings. Like, what is it historically?
Yeah, no, for sure. It's certainly expensive. It's well above kind of one standard deviation, depending on the time frame that you want to look at. In the last kind of 5 to 10 years, seems to hover around that 19 times. And if you were to go back, call it 50 years, the long run average is closer to that 16 and a half. So certainly a pretty significant valuation change coming into 2025. And like I said, there's a lot of expectations that get built into that. And now you're starting to see, I think, some of those expectations maybe come back to reality a little bit.
So then the big question becomes, is this a new state of affairs? Because for the last 10, 15 years, investors have just been conditioned to get their outperformance from the US and pretty much nowhere else.
For sure. So, I think there was definitely a period where investors had a moment of caution in 2022, right? Higher interest rates put a lot of pressure on U.S. tech stocks. You saw Europe outperform in 2022. You saw Canada outperform in 2022. And now, the U.S. had been a dominant player for the better part of, 23, 24. And now you're starting to see that change again. I'm not sure if it's necessarily a sea change. I think, you're starting to see some of the economic policy obviously come into play, tariffs and questions around taxes and, U.S. protectionism. I'm not convinced that this is necessarily the moment in time, you're going to look back another 10 years from now and say, okay, here's when the US started to underperform.
So then what would you need to see to believe that this is a shift?
So I think you need a little bit more clarity on the tariff front. Obviously, it's been an off again, on again process. And I think you need a little bit more clarity on the tariff front. I think you also need a little bit more clarity on what the respective global response will be. Um, I think if you go dollar for dollar tariffs, then there's a decent chance that this is going to become a bigger problem. If you get some moderation in the tariff discussion, and perhaps there's certain components that are maybe important to U.S. defense. So they've highlighted steel and aluminum as being one of those issues. That's probably not a sea change type moment.
And let's just to unpack this a little bit further. Yes, the US markets are down, and other markets like Europe and Hong Kong and even Canada to a lesser extent are doing better than the US markets. But you have to talk about tech, right, James? Because when you strip out the impact that tech has on the S&P 500, you neutralize it, you use it, look at the S&P equal weight, for example. It's not doing great, but it's flat compared to the S&P that weights tech more significantly. That's down more than 4%. So that really tells us that the pain is concentrated in those tech stocks.
I think so. The broadening of the U.S. market is generally a good thing. What we see in terms of our quantitative screen on the U.S., there's a number of names that are in more traditional industries that are showing the attributes that a growth at a reasonable price investor like ourselves are interested in. And I think we'll probably talk about it a little bit later on, but right now, certainly some of the tech enthusiasm is coming into check. I don't think that that's necessarily a bad thing. And I think there's also some potential opportunity that comes out from a revaluation in tech. And, this is a potential opportunity to step your toe into the market.
And there's one thing to talk about the markets and how they're a reflection of tariffs, but there are real things that are happening as a result, maybe not just of the tariff threats. We should also talk geopolitics. I mean, we're talking about Germany, for example, which is famous for fiscal restraint, that now as a result of some domestic national insecurity as a result of, Ukraine and Russia, Germany, the stalwart for fiscal restraint, is now talking stimulus and tossing aside some of the breaks they've had to make sure that they don't overindulge on debt.
Very much so. So you saw the fiscal spending plan come into place this week. I think investors were all excited about the prospect of Germany kind of turning the taps back on, and that's in stark contrast to what we think is happening in the U.S. Right, where you're seeing the U.S. with a bit of a spending problem and some potential austerity measures coming into play to kind of rein government in a little bit. So that dynamic certainly is a tailwind for European stocks. And I think you're starting to see that tailwind play out. Obviously, the first 2.5 months here of 2025, Europe's done well and, likely would continue to do well. You add in the desire, kind of the question about European defense spending and what level of defense spending is correct for Europe. It's likely higher than what it is today. And that's another catalyst for the European economy and European companies.
So let's talk about how this shows up in your portfolio, because I looked at your investments. You're still 60% US weighted. Talk to me about how that's evolved, how that could change over the year.
Yeah, for sure. So we take a more strategic view on our regional allocation. When we look back in history, we think that this mix of 60% US stocks in and about, with about 17 to 20% Europe, and the balance being other international markets, is a pretty good spot to be to weather multiple different storms. Like I said at the start, I'm not convinced that the U.S. underperformance is a kind of a long-term factor, and we're pretty comfortable with where we sit today. And then you layer in our choice of investment securities within the US. We are a growth at a reasonable price manager, so we are looking for growth that isn't priced kind of to the moon. And we think we're sitting in a pretty strong spot today.
All right, well, let's see if we can find some of those opportunities and we'll dip into the mailbag. Our first question is about Japan, and you're talking about, value maybe not being a four-letter word anymore, and certainly that's the perspective from Warren Buffett. The question is about Warren Buffett's Berkshire Hathaway. He's been investing more money in Japan, specifically the country's trading houses. Do you like the region, and if so, what would you buy?
So we do like the region. We've got about a 6% weight in Japan today. We've chosen to express that view through broader Japanese ETF. We thought the tailwinds that are sitting behind Japan were probably best expressed through a broad blanket on the region, as opposed to some individual securities. We like Japan for the valuation that you have to pay. You're able to step in that 12 times price to earnings, which is nearly half, what you have to pay to be in the US, coupled with a 2.75% to 3% dividend yield and a buyback yield that's in that 1.25% to 1.5% range. It's pretty attractive for shareholders. I think one of the pieces that's worth noting here as well, in the last 5 years, there's been a pretty strong shift in Japan with respect to how they choose to manage corporate governance. And that improvement in corporate governance, so either board operations, management's focus on profitability and growth, or the unwinding of some of the co-ownership that you see in Japanese companies, that's a good thing for shareholders. And maybe I should expand a little bit about the co-ownership. So that was a business practice largely followed in Japan to cement business relationships. So if I was Mitsubishi and I'm buying, I don't know, let's say I'm buying a fleet of vans for my for my staff, I might go and make an investment in Toyota, for instance, because I'm going to get a couple parts from Toyota for my vans. And so I'm going to own some of Toyota's shares, and in return, Toyota is going to own some of my shares. You're starting to see that unwind a little bit, and it means that capital is a little bit more efficiently being deployed in Japan, and you're starting to see some of the growth prospects improve.
Well, that's super interesting that those dynamics are coming to a little bit more of, say, international best practices. That's maybe one reason that it's becoming more attractive. And I think the Buffett piece is super interesting because he has said time and time again, he's kind of USA all the way. However, in his most recent letter, he said that Japan is a small but growing exception to that USA all the way ethos.
Absolutely. And I think, you've had 30 plus years of underperformance in Japan. And now you're starting to see that economy pick up. You're starting to see inflation back in Japan, which, is kind of a taboo word in every other region. If you bring up inflation in Japan, you're finally starting to see some price appreciation. And that's translating into some real growth for Japanese companies.
There's a lot happening in Japan right now. One of the things is, Japan is dealing with inflation, and Japan never deals with inflation, right? And so all of a sudden, it's a little bit of a problem. They are generally thought to be on a rate hiking path. And so that seems counterintuitive. We've been so used to investing in markets where there's easing and stimulus. Does the fact that the Bank of Japan is hiking rates, how does that show up in your investment thesis? One way that it's being expressed is a stronger yen, Japanese yen against the US dollar. So how should you think about, your currency exposure, central bank policy when you're investing in Japan?
Sure. So on the currency front, we do hedge our Japanese exposure to the US dollar 100%. I think obviously interest rates probably need to come up in Japan. They were at one point negative. So the path of least resistance is coming up. I'm not sure that we are in a spot where you're going to see a 2022 like cycle where all of a sudden Japanese interest rates are at 5%. But certainly, it's on a trajectory to move up closer into that 1%, 2% range, which is probably more normal and also, I think, probably healthy because it's reflecting that there is, in fact, some growth and some price appreciation happening in the Japanese economy. So I'm not particularly concerned at this point about the rising kind of interest rate environment in Japan. I think if we get up to that, call it 2% range, then perhaps then you need to start thinking about it a little bit differently.
Let's get to our next question. This one is about the European markets, which, as we know, have outperformed. The question is, do you believe European stocks will continue to outperform? And are there any specific equities that you like?
Sure. So in terms of Europe, we like Europe. We've got a 17.5% weight in Europe right now. Again, valuation is certainly in investors' favor, albeit it's not quite as cheap as it was, a few months ago. You're sitting at kind of that 17 times, and dividend yields are in the range of kind of 3% on the broad market. I think and we talked about this a little bit, the defense spending is obviously a positive for Europe. The fiscal spending that's coming from Germany is obviously a positive. And we think that you're going to start to see some more fiscal spending coming out of other European nations, which is also a tailwind for the European stocks. On an individual name, again, we're a GARP manager, so growth at a reasonable price. One of the names that we own is Novo Nordisk. We like Novo. They're the world's largest insulin provider. It's an interesting name because you've got this weight loss drug phenomenon happening, and you saw that kind of come to fruition and maybe peak investor excitement last June. The stock's off, I think about $60 from its high last June. And so at this valuation level and the prospects for future growth, we think it's pretty attractive.
So you'd buy the dips on Novo Nordisk. And that's really interesting because I think for a long time, that's probably all investors knew, especially if you were a generalist focusing on North America, you knew. I called it sort of the AI of Europe was those GLP-1s, those diabetes drugs. But, one perennial knock against the European markets is, yes, they might be outperforming this year, but do they have the companies that are going to be dominant over the next 10 years? Like, where are they on tech?
Yeah.
AI might have pulled back now, but there's no denying that AI is going to be so pervasive, and they are just not a leader there.
It's true. I think the support for some of the AI initiatives, so like an ASML holdings is an interesting one. I think in terms of tech, and this is a name that, you don't really hear a lot of people talk about, is Spotify. So the streaming service, music streaming predominantly, they are, second to YouTube in terms of monthly active users. There's about 675 million monthly active users on Spotify, of which there's about 244 million paid subscribers. They actually lead in terms of paid subscribers globally. I believe they're even ahead of Netflix by, call it 5 million subscribers. So pretty interesting business there. We think it's relatively attractive. We've got a small allocation there today. And we think that to add to that name, you're really looking for the profitability story to continue to play out. So historically, they had not been profitable. They were investing in their platform, driving that user growth, driving that subscriber growth. And now that you're starting to see the subscriber growth tick up almost organically, now you're starting to see some of the price increases happen. And for something like Spotify, their average paid subscriber across the entire platform is €485. So it's about 750 and change in terms of a subscriber cost in Canadian dollars. It's relatively low when you think about the entire platform. And we think there's probably some pretty decent price appreciation that could come from charging a little bit more for that subscription.
That profit story, you're right, has really turned around at Spotify. Like in 2023, on an adjusted profit basis, they were losing 165 million. Now in 2026, they are projected to have 3.3 billion in adjusted profit. That's a really rapid on switch for their profitability.
It's been a massive inflection, and we think largely it should continue. They started off with the music streaming. They moved into podcasts. One of the most notable ones was the Joe Rogan Experience. Right? They signed, I think it was $100 million deal for the Joe Rogan Experience. Now they've started to move into kind of video podcasts and then ebooks. And so we think there's some pretty decent growth prospects organically within inside their business for some of these different media outlets. And couple that with a really strong platform that has a pretty large uptake, not only in Europe, but globally. We like the business. We think it's interesting.
So, Mr. Growth at a reasonable price, can
Yeah.
we really call Spotify growth at a reasonable price? Like its forward multiple is 53 times, but I hear you that, if their profit is just in infancy, maybe that's not the right metric.
Yeah, for sure. So this is the balance with growth at a reasonable price that I think is really hard to communicate and then kind of quantify, right? So certainly their valuation looks fairly high. We think there's pretty decent opportunity for them to continue to grow in that 20 to 30% range. And when you start to look at other names in the space, we're not as convinced that they can necessarily grow at that pace. And so we think that the valuation today is a little bit more justified. Certainly, there was a pretty decent pullback within kind of the last week or so on the name. And that was, I think, what presented an opportunity to initiate a position.
Okay, let's move on to our third question. This one is about Asia, the Hang Seng in particular, which really is one of the best international markets so far this year. It's up 23%. The Hang Seng has been on a run since the start of the year. Do you like China exposure, Chinese tech stocks? Is DeepSeek a reason to bet on Chinese tech? And the Hang Seng, for perspective, is actually sitting at a 3-year high.
Yeah. So I think the way that we've chosen to express a view on China is through emerging markets. So we have an 8% weight on emerging markets today, of which that means that we've got about a 2% weight in China. So it's a little bit under what, say the MSCI emerging market weight would be on China. I think the prospects for fiscal spending, the prospects for a reinvestment in growth are all very encouraging for China. The interesting piece when you bring it back to the tariff debate and some of the political tension between China and the US, I think you're certainly starting to see some manufacturing move from China to India to the Philippines to Vietnam, et cetera, et cetera, et cetera. And we thought the best way to express the relative attractiveness of China at trough multiples kind of a year ago was to go more broadly in the entire emerging market space and participate that way.
So underweight China, and I should say actually one of the reasons that the Hang Seng in particular is doing so well is it's got Alibaba, and Alibaba has staged a huge recovery over the past year. And so far in 2025, it's up 70%. That's not the only reason, but it's a big driver. What would it take, or why aren't you as overweight China? What's kind of holding you back? Is it the tariff concern that even with fiscal stimulus, structurally, they could come out, as relative losers?
Right. I think it's less to do with the tariffs and more to do with the structure of, call it commerce in China. You saw the regulatory regime on big Chinese tech really ramp up in that 21 to 23. And now you're starting to see the Chinese Communist Party pull back a little bit on that regulation, trying to stimulate some more growth. I think that swing in regulation, no regulation, makes it difficult to step in with kind of a big overweight in China. there's some structural components there as well, where very long term, you've got an aging population. That part doesn't really concern me as much. I think it's more about kind of the actual business environment and climate that keeps us from being overweight.
All right, we're going to take a quick break and we'll dip back into the mailbag when we return. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. And we are back with James Cook. Now, we've been talking about global stocks, but as I mentioned, James still has about 60% of the portfolio in U.S. stocks. And so this is what this segment is really going to focus on, the U.S. holdings. Let's start with the question on Meta. Would you buy the dip on Meta? And it is down basically for no reason other than investors are throwing out their tech stocks, James. It's down about 20% from the all-time high that we just saw in the middle of February.
Yeah, there's been a decent price move there. Certainly, it's lots of action on it, and like you said, maybe a little bit of the baby going out with the bathwater. Meta's underlying business it's an amazing advertising business, right? When you think about the amount of users that are on Instagram, Facebook, you look at what's happening with WhatsApp. I think all of those things are really encouraging. Their consumer data should help them power some pretty interesting AI models, depending on what that is going to look like for them. And that's perhaps maybe what you're starting to see investors, question a little bit, right? Is, okay, have we maybe overpriced the potential for this name? And we think it's still, honestly, a GARP stock. We think it sits right in kind of the sweet spot where, you're seeing that 20% top line growth in a quarter. You're seeing pretty decent profitability. The criticism that I tend to get on this front is, what about the CapEx spend? What about the metaverse? And I think the point to point to with these guys is that most of their spending is coming out of cash flow from operations. They're not pulling on outside financing for kind of this new project base. They're able to internally finance most of their projects. And so that gives us a lot of comfort when we think about what they look like, not just next year, but maybe 5 years from now.
I'll disclose I own this one, but
Me too.
When you use the word GARP, growth at a reasonable price, like just to underline that point. So we've already said the S&P 500 is trading at 23 times, which is lofty for the index, but so is Meta. And it's really rare that you can get one of these high growth tech stocks at the same multiple as the market. And I'm just doing some quick math here. Looks like out of that so-called Magnificent Seven, other than Google, it is the cheapest Magnificent Seven.
Yeah. And I think that's a really good point, right? So there's a difference between, okay, what's expensive for the region or for the index, and then what's expensive for the individual name. And certainly Meta in that 23 times is not expensive. Again, really strong, profitable business that has shown an ability to grow its fundamentals faster than the market time and time again. So I don't think that, now's the time to necessarily bet against them. I think you can step in with a long-term view that their advertising business is incredibly strong.
Let's go to our second question. This one is about Mattel. Is it a buy? Are you worried about tariffs and what it means for toy makers like Mattel?
Yeah, Mattel is a pretty interesting name. There's so the company, kind of flagship products, Barbie dolls and Hot Wheels. And they stepped into a little different strategy when it came to trying to re-engage customers. So they've gone down this path of investing in entertainment. So you saw the Barbie movie come out. that obviously had a really good pull up for their product sales. And management has basically said that that's the strategy they're going to go after is, okay, how do we step into more entertainment, be it movies, other media, and try and drive some new life into, what used to be, call it staple or kind of older brands. So we think it's interesting. The Obviously the tariffs, most of their toy manufacturing happens in China, so they would be a candidate to see some kind of tariff impact on their cost of goods. I would think that gets flown through to the consumer. When you look at the cost of an individual Hot Wheels, it's anywhere between $1 to $5. If you buy the set, maybe you're in the $75 to $150, depending on how kind of complicated you want to get with the toys. And I'm not sure that the proposed tariffs are enough to sway the consumer from continuing to go out and buy the toys that their kids are excited about.
And so yes, the tariffs, their costs going up, but I think we should also talk about the demand picture.
Yeah.
There's a lot of caution about the consumer. I mean, even a company like General Mills, so such a staple, warning this week that their sales growth is going to be worse than expected because consumers are pulling back.
Yeah. Particularly in the US, the savings rate is near all-time lows, right? So that means that future consumption is primarily coming out of wages. And you're seeing people spend the lion's share of their, call it monthly budgets. That certainly is going to ebb and flow. I think the cyclicality around a toy maker, obviously you're going to see, more spending in good times, perhaps a little bit less spending in bad times. But putting Christmas presents under the tree, birthday presents, that sort of thing. I don't think that necessarily goes away. Perhaps it's, 4 different cars instead of 5 or 10. Right. So I'm not particularly concerned about the cyclicality of their business. I think if you're going to buy a toy maker like this, you're looking for the value of their brands, and you're thinking over the long term, what price am I paying today, and can I step in at a reasonable level? And I think they're priced right around 12, 13 times on a trailing, which I think is relatively attractive.
All right. So you would feel comfortable stepping in here?
I would.
Our next question is about CSX. This is a railway operator. Shares have struggled over the past year. Is now a good time to buy the railroad? I don't know. When we're in a trade war, do you want to own a railroad that is primarily based on trade between nations?
So I've got a little bit of a hot take about this, and yes, I would. Do you remember the Baltimore Bridge that collapsed when a ship ran into it last year?
Yes. Yeah.
So the Port of Baltimore shut down. CSX is a regional railroad, primarily on the eastern coast and eastern side of the U.S. They were absolutely impacted by the shutdown of the port. There was a financial impact there. They had to make some adjustments to their business. And I think that's partially why you saw their shares struggle last year. So you fast forward to now, port's back open. They've made some adjustments to increase their flexibility. And I think that speaks well for their business. They aren't making any more railroads. They're not making more railroad tracks. So you've got a pretty wide moat to begin with. And rather than perhaps the U.S. is importing goods from a port, perhaps they are trying to move to exporting those goods from their port. And either way that you slice it, you have to move those goods from manufacturing facilities to the port. And one of the most economical ways to do so is rail. So I think you kind of buy through the fear on this one.
What is their network? Like, do they go into Mexico?
No, they don't. So they
fully
are
regional.
Yeah, fully regional. And on the eastern side of the U.S. For the most part, and so pretty dense areas. There's not a lot of room for expansion. The tracks that are there and the utilization that's there is basically up for limited amount of expansion. And I think that makes them pretty interesting and provides a bit of a moat.
Okay, so that's CSX. I'd love, do you prefer CSX because their network is kind of concentrated there over, say, a CN Rail, which, is also down in the dumps. And for
Right.
disclosure, I own that. um, or even like a CP Rail. Is that when you would
CPKC,
have,
yeah.
yeah, is that when you'd avoid because it does have that three country exposure, and right now one of those countries is angry at both of their trading partners.
Yeah, it's I think the I'm not as concerned about the tariffs when it comes to the rail. I think that's the best way to sum it up. Yes, there will be some changes. I still think that if you're going to relocate manufacturing, there's a huge long lead time there, and the ability to go and do so still involves railroads. So I like all of them. What I like about CSX is that you've got this kind of catalyst from last year where they were pulled down from an external event, and now they've got some ability for a bit of a runway here, and some easier comps going into this year.
All right, fascinating perspective on that. Let's squeeze in one more question before we get into your pro picks. This one's on United Health, another very controversial name for different reasons. But of course, there was basically the assassination of one of their subgroup CEOs. And while that was abhorrent, it also seemed to ignite an awakening about the practices of these managed care, these health insurance companies, and that has affected the stock.
It has. I think the 52-week high was right around $620. I want to say, and I believe they touched 440 about a month ago, and now they've kind of come back a little bit. So the underlying business, United Health, so the insurance side serves somewhere in the range of 45 million, 50 million Americans. And the Optimum side, which is care delivery, so hospital networks, serves something like 150 million Americans, give or take. So you're talking about almost 2/3 of the American population that gets some kind of care from United Health. So I think that in itself suggests that if you're going to bet against the name, you should take a bet against the way American healthcare is structured. Certainly, the Trump administration has not been as, probably won't be as favorable to the existing healthcare setup. I know there's, I think, a bipartisan bill talking about trying to break up some of the pharmacy components of these conglomerates. So there will be, I think, some more change happening in the industry over certainly the next year, if not 2 or 3 years out. With that said, the business, I think, is pretty fairly valued at this price. So if you don't believe that entitlements are going to get cut, if you don't believe that the care system in the US is going to change materially, then I think it's a pretty decent valuation to step into a name like United Health.
That doesn't imply that it's dirt cheap, though. It does imply that those are meaningful risks, especially for someone who's in the White House right now that is slashing things and rearranging things that we thought, were core industries and departments. I don't think it's outside the realm of possibility that there's a major shakeup in the way healthcare is administered in the US.
For sure. I don't think it's outside of the realm of possibility either. It's certainly not dirt cheap. I don't think that I would make it a top pick, so to speak. But I wouldn't be shying away from it if you own it. Let's put it that way.
All right. Well, let's find out what your pro picks are and get into those. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, James, your first pro pick is Fortinet, cybersecurity. Why do you like it?
So when we think about cybersecurity, there's been a number of problems, right? You saw Delta Airlines and CrowdStrike had an issue last summer. United Health, as we talked about, had a problem last spring or last winter, I guess it would have been. I think those incidents of cyber breaches are probably not going down. I think they're probably going up. And I think the amount of money that you need to spend to maintain your technology infrastructure and defense is likely going to be higher tomorrow than it is today. We think Fortinet's really well positioned in the space with both hardware and software as a solution. So it means that a customer can come to them and buy their entire product suite rather than only going for a software solution or only going for a hardware solution. Couple that with really strong profitability and some fairly consistent top line growth numbers. We think they're pretty attractive today and fairly priced.
What kind of upside do you see on Fortinet?
I mean, I think it depends on your time frame, but realistically, I think there's probably 20 or 30%.
Let's move on to your second pick, which is S&P Global.
Yeah.
The S&P 500, they are an index maker. So they kind of do a bunch of indexes, the S&P TSX. And then they also have like a big data component. But help us understand what this company is and why you like it.
Sure. So I think one, it's something that kind of flies under the radar. One of their big competitors, Moody's. So they're both financial data providers. They both provide ratings on corporate debt, government debt, et cetera, et cetera. And then they've got this index component as well. And so for S&P Global, we think it's a pretty attractive business when you look at the refinancing that's going to happen in corporate debt over the next 3 to 5 years. They've been very consistent in defending their margins, and they've been pretty consistent with growing their business. S&P has a new management team coming in. So Martina Chung has been with the company for 14 years. She's taken over as CEO. And so we think that the kind of new energy from a new management team is a good thing for a relatively stable, kind of boring business like S&P Global, and their ability to continue to invest in technology positions them really well to continue to defend their margins and grow their business. So when you think about things like AI, AI monetization, their ability to streamline workflows, manage data, and then monetize that data and resell, we think it's pretty attractive.
So what would you call this an inexpensive stock?
No, you are paying a bit of a premium here. The moat around it, I think, is what justifies that premium. And the recurring revenue model that sits behind them, I think, is the other piece that justifies the business. We were talking about Mattel earlier. Like, I would think that S&P Global outgrows Mattel, right? And so you are going to have to pay a bit of a premium there, and you're seeing that difference in pricing come in, right? Mattel at 12 times and S&P where it is.
All right, your third one is MasterCard. We were just talking about troubles potentially with the consumer. So it's interesting that you're picking up MasterCard. And you know what? It's had a bit of a pullback, it's down about 7% from its all-time high.
Yeah. So what we like about MasterCard is their global business, and we like their margins. We like their continued discipline and execution. We like how they are putting some fintech partnerships first and continuing to invest in what their business is in terms of payments. Certainly, the concern or the risk here is the consumer, and does consumer spending continue to grow, et cetera, et cetera. What I can say is that if you look at the average hourly earnings in the US and you multiply that by the average number of private payrolls and you multiply that by the average hours worked, that number has pretty much grown consistently outside of the GFC and outside of COVID. So I think over the long term, this is a name that will continue to grow. And when we think about a bit of volatility in the marketplace and a pullback on a really quality name, I think MasterCard is one that stands out.
And would you prefer it over a Visa? Which, looking at these credit card companies over the last year, MasterCard has lagged the move in Visa.
Yeah. So I think MasterCard obviously is a little bit smaller than Visa. Call it 4 billion cards issued for Visa, and I think it's 2.9 or 3 billion for MasterCard. I think that MasterCard has been spending and putting their efforts in the right spots to try and grow their business. And I think if you look at it as a bit of an underdog, I think they've got the prospects to continue to do well into the future.
All right. Thanks so much, James, for joining us with all of these insights.
Of course. Happy to be here. Thank you.
Thank you so much to James Cook of Matco for joining us. Make sure you stick with us on our next episode. We've got Rebecca Telcher on the show. She's of New Haven Asset Management, and she loves her defensive stocks. She loves her dividend payers, and I know you do as well. So get your questions in. You can email us at questions@inthemoneypod.com. You can find us anywhere on social media @InTheMoneyPod, and we'll catch you on the next episode.